So in 2010, we were ready to start investing. Foreclosures were at the highest rates. Properties were selling for $20,000, $30,000 per door, which is super cheap. And we started creating a portfolio of single family homes, because at this time we decided that we were just going to be holding, starting in slow. We were going to learn the process of how to get into the rental industry. Okay. Sorry about that. I didn't know okay. Oh. Okay, so at that point, we started investing in multifamily, started very little, started learning what management was all about. And at that point, we were able to create a portfolio from 2011 all the way to 2017 of 330 doors. And there were garden-style apartments, which I don't know if you guys are very familiar with the styles of apartment buildings, but that's like a Class C apartment buildings. And we were doing extremely well with cash flow and building a portfolio that was growing in monthly cash flow to us. Every month, we were able to raise rents. If a lease would expired, we would be able to raise those rents. And at that point, once you're able to raise rent, you're able to increase the valuation of your property. So we kept on increasing that value, and we were like really happy with getting into the business, really deep diving. And in 2017, they came to us, and everybody wanted to buy the type of buildings that we had, but we were saying, no, we're long-term holders, we're not going to sell. At the end of the day, we decided that we were going to move up and scale into different types of apartment buildings. And we sold those 330 units and profited $18 million within 6 years of holding that portfolio. So that's what cash flow is able to do when you are invested into a property, that you're able to move up the valuation on a yearly basis just by increasing rents. So multifamily for us is where we love to invest. That's where all of our that's where all of our capital goes, is to cash flow properties. So I'm going to show you, this is a crazy pictures. This is when me and Bobby first met. I was pregnant with my daughter there. I was 19 years old, and Bobby was 23. And this is today. That was probably about a year ago in Africa when we went. So I have a saying that is, if cash is king, then cash flow is queen. That's one of my favorite sayings. I use it all the time because, they love to call me the queen of real estate, because I'm always involved in everything that has to do with our business with the real estate. So I'm here. I'm going to start with the 5 steps to real estate royalty. And this is how we created our $450 million portfolio today. We have 5 steps that we always take before doing any kind of investment. My number 1 is core value. Core value is essential for getting ready to invest in real estate. This is just like living your own life. You always have to have core values, because if you don't have a core value, you just don't know where you're going to take the next step, or what kind of properties do you want, what do you want out of your investment. My number 1 core value is always that I take a look at what property size do I want. And this is very important for everybody in this room to understand, because property size comes along with your financial needs. Like how much money do you have to invest? Because everybody could say, I want a 50-door property. I want a 100-door property. I want this. But do you have the capital to invest in it? So you have to make sure be realistic of the size that you're purchasing, so that you're able to know that you're going to be able to afford it. Okay? I always advise everybody to start with the small properties, so that you could understand how to manage those properties, what you're going to be expecting on that investment. They're easier to manage at the very beginning. And with small properties for the beginners, if you do anything under 5 doors, you're able to get like a residential mortgage for it, and it's a way easier process than being able to go into a bank and say, I'm a first-time investor, I want to get a commercial loan. So it's a little bit easier for the very beginning. My second one is location. Locations vary from A through D, and I'm not sure how familiar you guys are with when you classify a location. But if you go to an A location, that means that the income for everybody is a very high net worth income usually. You have high rises, you have concierge services in these buildings. They have high amenities. A B location is more like that workforce housing. C location is when you have government assistance that they give, like Section 8 or some type of program that they allow low income. D location is more like the projects HUD homes. At the very beginning, when me and Bobby first invested, we started with the C location. C location's a great asset to start with because when the government pays those rents for those tenants, no matter if that tenant has a job or not, you're going to be receiving that rental income on the 3rd of every month. And this is Florida, guys. I'm not sure of California the way it works. So I'm just talking the knowledge that I have where I invest in. But so those assets are very good to start off with because you're not going to be worrying about having to have big collections on your property. And today we only invest in B or A minus properties. We have probably 2 A plus properties in our portfolios, and it was one of those circumstances that just fell on our lap. But what we mostly concentrate on is that B location. These are where we have properties at. We mostly concentrate in Florida because it's our backyard. We know it, we're there, we're able to drive to the assets, but we do have some in Texas and in Tennessee. The other one is asset class. We always look at what type of asset class do we want? Do we want the A's that you're going to have more of that high level tenant where you're going to have doctors, you're going to have attorneys, you're going to have that 100 plus a year tenant. Then you have the properties asset class B, which is one of those more of the 3-4 story buildings with some amenities, not many. And C class is really having no amenities. You'll rarely find a C class that has a pool. If you do, that's one scattered. And then the D really has 0 amenities. It's just more of that HUD housing, like I said. These are examples of properties that we own right now. Number 1 is an example of an A class. This is in El Paso, Texas. We just purchased this in April. It's a great asset. It's 400 units, and it is one of our most best properties on cash flow right now. It's our cash cow is what we call that property. Property 2, this property is a perfect example of what a B-class property is. It's 2 stories, garden style, has a pool, has a little park. Property 3, this is a perfect example of a C-class property. This is where the governments help you pay the rent. This is one of our first properties that we ever invested in. And property 4 is an example of a D-class property. See, it has no amenities. It is just straightforward. You have your apartment, and in and out you go. The other one is short-term or long-term hold. This is when you're going to go into a property knowing, are you going to hold it for a short term because it's a property that you're going to put a lot of money into it and you're able to sell it within a year or 2 and double or triple your investment in this property. This is where you're going to see a good large ROI. A long term is more for building wealth. This is where you're going to hold a property for cash flow, for it to increase in value throughout the years. The tax benefit on a property like this is huge. You're able to, really take advantage of a lot of taxes that you could deduct, that you're able to take advantage because you own a real estate property and you're, able to deduct a lot due to that fact. My second step here is an A+ team for your resources. This is also a very, very important part because these resources are the ones that are going to be able to take your multifamily portfolio from one level to the next. You really need to network with these people. You really need to be in with them, be their best friends, and understand that they're going to be your partners. They're not your employees, they're your partners. And these are your CPAs. CPAs, make sure if you guys are involved in real estate that you get the correct CPA that understands real estate investment. There's a bunch of CPAs, and I could tell you from experience, some of them have no clue that there's special deductions for real estate investments. So make sure that if you do invest, that you go look for that real estate CPA. The other one is your real estate broker. This one's another person that's going to be one of your best friends. If you get realtors that understand your core value, that they know what type of asset properties and locations you are looking for, they're going to bring you deals that are off market. They're going to bring you deals that they know exactly are going to fit your core value. You're not going to waste your day, your time. Underwriting a deal takes time. And if you're underwriting a deal that doesn't meet your core value, you're just wasting time. So a real estate broker is somebody that you really want to network with. You only use one real estate broker. I use a few, but those few really know exactly what we are looking for. When we are looking for it, they'll bring us deals like El Paso. Like I said, that's something that we would have never really looked at, El Paso. We don't even know El Paso. We've never had been there. But this broker knew our core value. They knew that we look for cash flow properties. They brought us this deal off market, and we were able to get a huge cash flow property that we would have never known about because we don't know El Paso, like I said. So we had a great relationship with this broker, and we were able to get this property. Debt provider. Debt provider is another one that's another person that's super important in your team. When you want to buy property, you need to be able to leverage yourself, properly leverage, but not over leverage. But when you start investing in multifamily, it's hard for a bank or a lender to say, I'm going to lend you to invest in an investment property, but you've never done it before. So you have to create relationships with debt providers, your local bank, your community banks, your a mortgage broker that understands multifamily, and that once they create that relationship with you, they're able to fight to say, hey, this is a reliable person. They have great credit. They're able